Alrighty, here we go. We might have a new sheriff in town. I'm not sure. We'll have to check out the scorecard here in a bit and see how things turned out there. But today, by the way, is the start of the Masters golf tournament. I know everybody's thrilled with that. Off to an early lead is Charlie Hoffman, I think, with -2. Tom Watson, old Tom, is at even par as we speak so far, but that's only after 4 or 5 holes, so that's pretty good. Tom's close to 65, I think, so it'd be cool if he would stay somewhat competitive. Has Tom Watson ever won I was thinking about that. Has he ever won the Masters, you guys know? Yeah. So he's probably still playing just on, because the Masters has all kinds of criteria, but probably based on his British Open finish from a few years ago, he's probably still qualified. So, yeah. Nearly won the British Open at the age of 60. One stroll while he was in a playoff. That's how it turned out. Did you guys watch any of that? Yeah, the British Open when Tom was about winning, should have won it. Yeah. Well. Let's take a look at last week's homework first. See how everybody did. I got a little bit caught up on correcting. I didn't realize I was as far behind. I'd kind of gone through and saved drafts. I'd put some comments and all your guys' stuff and saved drafts, which you guys can't see, and I must have thought that I had graded them, but I had not, and so I kind of got caught up a little bit yesterday. I think I'm still one round behind, but I'll keep working on that. Oops, I should have done the 5th round. Now, of course, my computer's going to slow up here. Okay, so last week's assignment. What would be the effects of extending the accounts receivable period from 30 days to 60 days? I don't think I've seen too many groups really experimenting with either the accounts receivable nor the accounts payable. The accounts receivable would create a few effects, right? One, it would increase sales. Okay, if you went from 30 days to 60 days, you're going to have more folks interested in doing business with you because they have a little bit longer time to pay, right? So that would be kind of nice. 2, though, or B, it would increase your accounts receivable, right? Because more people are going to take advantage of that, and they're going to drag out the payment to you, and thus it's going to effectively decrease your cash, or at least your cash flow, cash coming in, okay? At least for one round. You know, those things tend to level out then kind of over time, right? And then C, it would increase your expenses. You'd end up having some more bad debt, right? Because the people that want to take advantage of 60 days maybe aren't as upstanding, how's that, as people that would pay you in 30 days, and so you might tend to have a little bit extra expense because of that. You guys think of any others? I hadn't reviewed your guys' answers yet, so I think those would be the main ones. And accounts payable would kind of be the opposite a little bit. Would be the effects in extending the accounts payable. So this is what you're paying your suppliers, right? You could increase your cash. So if you had a temporary need for some cash, it's really like taking out a short-term loan. Okay, so you could increase your cash position, right? But it would increase your expense because they're going to charge you some fees, right? They're going to charge you some fees for extending out your payment to that 60 days. They're going to charge you interest, sorry. But it would and I didn't maybe get the right word for this, but decrease your supplier reliability. So it's going to increase your expense on that side a little bit too. Your suppliers aren't going to be as enamored with you or as they are with your competitors, and so it might tend to drive up your costs a little bit on materials and whatnot. Okay, could, and it does actually in the game. So, okay, but there are some, there's some. Let's put it this way. I've seen some teams use these effectively in the past, and I don't think you guys have experimented with them at all. So, and it may be a little late in the game. Okay. 3, if Erie would have paid a dividend equal to its entire cash balance, what would that have done to Erie's leverage ratio? leverage calculated in this game as total assets divided by total equity. And so the leverage ratio before the calculation is equal to 1.9. That's given to us right on the report in there. The total assets would be reduced to 192,331, and equity would be reduced to 80,842 if you took off their cash, which was what, 38,000 something, or 38 million. Okay, I think it was something like that, wasn't it? 38, 39. Let's go back and look. Sorry. So Erie cash. Yeah, 38,485,000. So I deducted that from each of these. Okay, why do I deduct it from each of these? Well, if you lower total assets, then you're going to lower equity by the same amount. Paying out a dividend is just pure getting rid of equity, basically. Getting rid of assets, getting rid of equity. Okay, so you reduce them both by the same amount. Okay, but that definitely changes the leverage, right? So it makes them a riskier company. They go from 1.9, which is fine by my scorecard, up to 2.38, which would be a deduction, right? So if they paid that much out, okay. But think about the good things too that would happen if they did that, right? What would happen to their return on equity? We've done some exercises like that in the past. Their return on equity would increase then, okay? Because their equity would go down by, heck, that would be lowering their equity by almost a third, right? So their ROE would go up substantially, actually. Why are the labor costs per unit lower for Baker, which is a traditional product, than for bead, which is a low-end product? Normally you would think that bead, right, would be a lower cost product to produce. The answer is that Baker has more automation, number one, and two, Baker did have less overtime. All the other things, the things like investing in TQM and those types of things, that would affect each of those equally, you would think. Okay, but it did have a different automation and a little less overtime. So, okay, document some of the effects of borrowing money to buy back stock. McKell and I think, had a conversation about this a little bit, right? And I think I told you guys yesterday that next to borrowing, or I was talking to some of you, I guess, yesterday. So those of you, or Tuesday, or those of you that weren't here, this will be new to you. But since it's late in the game, I'll give you kind of what my tactics, maybe some of my tactics would have been. Early in the game, I would have borrowed every penny I could have possibly borrowed, as much as the game would have allowed, and purchased automation, just bar none, especially in the low and traditional segments. I'd have bumped it up just as fast and as rapidly as I possibly could. The payoff's just too big. Okay? The payoff's too big and it lasts too long, and to borrow money on the front end to do that. Okay. Next to that, okay, if I ran out of automation, if I couldn't buy anymore, or if I thought I had gotten it up as big as I wanted to, then I'd buy back stock. Then I'd borrow money. Again, I would borrow every penny I could to buy back stock in this game. Again, it's just too compelling. There's just too many good reasons to do that, because you're in such a rapidly growing industry. Okay, you're borrowing money at a fixed rate. It's a high rate in this game, but it's at a fixed rate, right? Okay, so you're borrowing money, but your growth rate's compounding. Everybody understand that? If you can borrow money, even and you're probably paying it down, because you got to make payments on most long-term debt. Even if you're not paying it down, your interest stays the same, right? But your growth is compounding, meaning that you grow 10% this year, you're at 100. You grow 10%, you're at 110 next year. You grow 10% next year, you add 11, right? So you go up to 121 the next year, right? So it compounds. Yeah, just no reason not to. A little late in the game to be doing that. That's the only reason I bring it up now. Not that it's too late to buy back stock and do some of those things, but it wouldn't have quite the impact as it would if you did it early on. Document some of the effects of borrowing money to buy back stock. One, it would decrease your equity. Okay, great, because you're getting rid of cash. Okay. Two, it would decrease your shares outstanding. It's a wonderful thing. A lot of you guys on 5 did the calculation backwards. You added, when I said you buy back stock, you buy back 200,000 shares. You're buying it back, and a lot of you added that. Instead of having 1.8 million shares, you put 2.2 million down in your calculation. Okay, buying back means that you're retiring that stock. It's not available to the outside world anymore. Okay, so you decrease your shares outstanding. It would increase your expenses. interest and costs associated with the transaction, right? Okay. It would increase your leverage, which could be negative. That could be risky. If you did what I said at the beginning, you'd definitely get dinged for leverage. Absolutely no questions. You'd get dinged for leverage because I'd be borrowed up. I'd probably be 3.5 leverage. It'd just be riskier than hell. Okay. But having seen the game so many times, I think it would be worth that risk. And then perhaps decrease working capital if you're borrowing short term. Right? If you're borrowing short term versus long term. If you're borrowing long term, it's not going to have an effect on your working capital to buy back stock. But if you're borrowing short term, it's going to have an effect on your working capital. Those are the ones I could think of. You guys may have some more when I go through your assignment, I'll see, but those are the ones that I could think of anyhow. So, you guys got any more off the top of your head? Okay. So let's take a look at this round. This one got to be a little bit. Oops, I'm in round 6 still. I'm sorry, I got to go back to round. I'm in round 5. I got to go back to round 6 here. Pretty competitive. Look at the sales here. Chester, Digby, Erie, Ferris, all over 200 million. Ferris and Chester pushing 300 million. Right? If they grow again, they should be well over 300 million this next round. We would assume. Andrews and Baldwin a little bit smaller. I'm gonna say you can go small and you can probably still win a round. It's gonna take some fine-tuning of the decisions in order to get there. Okay, it's going to take some big-time fine-tuning of decisions in order to get there, but it could certainly happen. Okay, small companies can be as valuable an investment, maybe more so in some cases, because they got a lot more room to grow. Okay, than big companies, right? You know, does anybody think that Apple can continue to grow at the pace that it has? And it can in a dollar term, right? But in terms of a percentage of growth, it's going to decrease. You know, if they grew 100 billion last year and they grow 100 billion this year, you know, last year's growth might have been 20%. This year, that might only be 15% because they're that much bigger, right? And so the percentage of growth tends to decrease, and so it's a little tough to keep that up as you get bigger. Got some tremendous ROEs. 41% for Digby. Wow. Man, give me some money to invest there, but I would invest in Chester. I'd invest in Andrews. Andrews actually 17.9, Ferris only 11.8, so Andrews actually thumped Ferris in terms of ROE. And Erie 22.4 is nothing to sneeze at, that's for darn sure. Profits, everybody's profitable. That might be the first time in the competitive rounds that every team has been profitable, so yay. Yay. SG&A expenses, you know, kind of interesting. Baldwin's still a little high, and again, probably as much because they've got low sales as anything. Contribution margin, look at that, huge, 49, nearly 50%, and 46. So it wouldn't surprise me that we'll get some teams that will exceed that 50% contribution margin, you know, before in the last 2 rounds. 45, Chester 34, you know, one of the lowest, right? Ferris is the lowest, Chester's the second lowest. You know, you shrug your shoulders a little bit, though, and you say they got the highest sales, the 2 teams do, so are they sacrificing maybe a little bit of margin in order to push sales? The answer is probably, right? There's some reasons for their sales being that high, maybe. Maybe it's a little bit lower price in those particular segments, I'm not sure. Maybe it's a little bit higher costs, okay? So hard to say, but their contribution margins are definitely, you know, 10%. In Ferris's case, 14% lower, right, which is huge. Okay, 10% lower, right, on $270 million in sales. That's $27 million, right, in profits. So in gross profits, anyhow. So it's a huge factor. Stock market, Chester bought back a little bit of stock. First time we've seen that, so I don't know if they maxed out. They'll limit how much you can max out. I think you guys said you hadn't maxed out quite. So, and Digby actually bought back some stock because they were up over 3.1, right? But remember, up above, Digby had the highest ROE, substantially the highest ROE and the highest profits, and yet look at Chester has by far a huge lead in earnings per share. Okay, huge lead in earnings per share, almost $5 a share. So a huge flop there, right? About a $10 million difference in profit. Digby leading there, but Chester has a huge increase in earnings per share. As a stockholder, what do I care about? You know, in this case, I kind of want that earnings per share. Now, I'm gonna digress here a little bit and get off topic a little bit. In this game, we can compare earnings per share because every team started out equally, right? Okay. When you look at companies in the real world, earnings per share is meaningless. Okay. Earnings per share is totally meaningless because you don't know how many shares are outstanding for each company. They issue stock. You know, for example, Berkshire Hathaway, I know I use, but their Class A share, it earns about, I think it's, somebody could look that up, but it's about $13,000 per share each year. Of course, it costs you $200,000 to buy one share of stock, right? So if you want one share of stock, you're going to pay 200 grand. Sure, it earns $13,000 per share per year. Great, wonderful, right? Is that any different than a company that sells for $200 a share and earns $13? The ratio is the same, right? Okay, so it's more that ratio that you would worry about. We call it price to earnings ratio. Actually, it's price to earnings ratio that you'd look at. And that is recorded over here. It's a little bit arbitrary in this game. In real life, it's an interesting number to look at. The price to earnings ratio is an interesting number to look at if you're thinking about getting out and investing, which you should be. You guys are all going to be leaving college here soon. Hopefully, you're going to be getting some jobs and saving some money and investing that money into things. And the price to earnings ratio can be a real thing that you, not something you focus on totally, but something that can be of some importance. The 30.7 would be somewhat high compared to real stocks right now. Every other one here is really low. Okay, the S&P right now averages about 16 or 17, I think, on the price to earnings ratio overall. Okay, so anything below, 15 I would call pretty low. 14, 15 is the historical average. The market's probably a little overpriced right now. 30.7 is a little bit high. That may be a reflection of the in the real world. If you had a stock, I guarantee you that GoPro, fairly new stock that just went public, in Twitter, I guarantee you that their price to earning ratios are really high because there's an anticipation of huge growth in those companies. Okay, whereas a company more Canon cameras, compare that to GoPro, say, I don't know if Canon, if you can buy their stock, right? But their price to earnings ratio is probably more like 10 or 12 or something like that because it's an old boring company. Okay? Just to give you an idea, digress a little bit, I'm sorry. Chester, no debt. Other teams have some debt. That might have hurt Chester. Okay, it's possible that hurt Chester. Maybe they've got maybe they've got too much equity. Who knows? So maybe they could have borrowed some money. Okay, maybe they could have done a few other things to eliminate some equity that might have helped them on the ROE, right? Take a look. Let's go down. I'm curious now. I hadn't even thought about that. But Chester's total equity is 141. Digby's only 102. Right? Digby has, what's that? 60, 75, 70, 76, 77 million dollars in debt, in long-term debt. They both got some short-term debt, but in long-term debt, they got 75, 76, 77 million in long-term debt. Chester has zero. Okay, Chester's got a wonderful, it doesn't show here, but it shows, I think, someplace else. They got a wonderful AAA rating. Okay, a lot of good that does them. Okay, because their ROE is substantially lower than Digby's in this case. So, and that all has to do with the amount of equity. Okay, so what are some things you could do to lower that? Would it make sense? I asked you this question last time. I think I said, what if you borrow money to buy back stock? Well, what if you're limited as to how much stock you can buy back? Maybe you can do it with cash on hand. How else could you lower your equity? What else would you have to do? Would it make sense to leverage up to actually borrow money and pay a dividend? Ugh. That's a goofball thing to even think about, isn't it? But real companies do that all the time, actually. Okay, there's real companies that do that all the time, even though it sounds kind of silly that you'd actually borrow money to pay back a dividend. But in a case like Chester, they're cash poor, but they're equity rich, right? Biggest company other than Ferris. Okay, cash poor, equity rich, and they're also debt free, basically, in the long term side. Of course, one of the big elements that they have here is huge inventory, right? Chester ended up with a lot more inventory. The other teams, you look at these other teams and you say that's virtually no inventory. So that was one of the defining things, I think, this round is you had Chester with $54 million in inventory, and that's more than all the other teams combined, substantially more than all the other teams combined. So, okay. In our cash flow, look at that. We still got some teams investing. Chester invested quite a bit. I don't know if they maybe did some capacity expansion, or maybe they did some automation. We'll see. And Ferris and Erie. Ooh, what happened there? I'm not going to tell you because that's one of the questions I think on your assignment for this week. So we know that Andrews, Chester, Erie, and Ferris all spent money on plant improvements. Digby has a positive number there instead of a negative number. So what happened there? Ooh, okay. That's going to be one of your guys' questions, I know, for the assignment. So fortunately, well, I'm not going to say that. Not yet. Okay. Purchase of common stock. So we saw both Chester and Digby actually bought back some stock. Remember, Digby was selling stock early in the game. They were selling stock like crazy. They sold over 1 million shares. They're just now starting to buy that back. And they probably sold stock at a cheaper price than they're buying it back. So that's the opposite of what you want to do. They're selling low, buying high, right? We'd prefer to buy high or buy low and sell high, but it doesn't work out that way sometimes. Look at that, lots of cash. Holy cow. Holy smokes. Chester's the only team that doesn't have any cash. Actually had a small, okay, but Chester's also the only team that doesn't have any debt. So it's kind of an interesting comparison that we make there, right? Other teams, Digby, Erie, and Ferris, what are they going to do with all that cash? They can pay down debt, right? Nothing wrong with that. Pay down debt. Don't change your equity position, right, if you pay down debt. Okay. But that is one possible use of that. Other possible uses then would be to return some of that cash to your shareholders, either in the form of buybacks and or dividends. So we'll see what they choose to do. There are certainly, I would tell you that when you compare those two, there are certainly ones that, in terms of my scorecard, that are far more advantageous than others. Okay, so when you're looking at those kinds of options, it's important to kind of keep, I think, to keep that in mind. Total fixed assets. That's kind of amazing that, while Chester has, just about the most equity next to Ferris, really it's not that big of a company. It's only the third biggest and just ahead of Digby, but all kinds of equity. So that's kind of interesting how they have that. Again, it's because they have no debt. And if you look at the other teams, and what do we say for Digby, 70-some million in debt? Erie, holy cow, 20, 40, 50, 60, 70, 80 million. There's at least 80 or 90 million there in debt, right? Okay. Debt, from a personal standpoint, it's great to be out of debt. I really encourage you to stay out of as much debt as possible, especially for depreciating assets, which are most of the assets you'll ever own. Your house might be the only exception. So in my opinion, personally, you should never borrow money. Personally, you should never borrow money to buy an asset that's going to depreciate. Vehicles, bikes, anything like that. Okay. In my opinion, if you're borrowing money to make investments, that can be a different story. Land, stocks, those types of things might be different. In the corporate world, it's kind of the same thing. But in the business world, you're just about always investing money then in things that are going to, that should help you improve, right? Even though some of those assets are depreciable, right? Your house, you don't get to depreciate on your taxes as a person, but you get to depreciate buildings and equipment and those types of things. So they are depreciable assets, But oftentimes, even like buildings and those things, even though you get to depreciate them, they don't actually depreciate. It's kind of an oddball thing. It's one of those quirky accounting things. That's going to be one of your questions too. So look at that. Ferris must have bought all kinds of more capacity. So now they've got way more than twice as much capacity as they need. Erie must have bought some more capacity. Chester's the only team that's really kind of sort of using its capacity, and Digby even isn't really using its capacity, and Andrews and Baldwin certainly are not. And one of your questions is going to be, what's the cost of unused capacity? And it's not a numerical answer, it's what are some of those costs that can happen because of unused capacity, right? And so I want you to be thinking about that a little bit here, right? You know, it's kind of an unseen cost, right? Because it doesn't really show up. There isn't a line item in your financial statement that says, oh, geez, here you've got unused capacity, so we're going to charge you $10 million a year, right? Okay, but there are some costs that show up, you know, come up here on your income statement, right? And there's some expenses here. Be thinking of some of those expenses that may be exacerbated anyhow because you've got capacity out there that you're not using, right? It's easy to look at the wage or the labor cost and say, well, we're saving some labor costs because we're not paying overtime, but we forget some of the other costs that we have when we have unused capacity. So I want you guys to think about that. I think that's extremely important. In inventory, Baker on the traditional side had a lot of inventory, but otherwise you look at Chester, and they were the ones that got stuck with a decent amount of inventory other than in the low end. Okay, they got stuck with a decent amount of inventory, 54 million, we decided. It doesn't look like they really upped their automation that much, so it looks to me like even though they spent some money, they must have maybe spent some in automation, but it looks like probably more so over here in capacity, maybe. Maybe their automation was quite a bit lower than that, I'm not sure. Boy, look at Erie getting up there in the automation. Look at their labor costs getting down to 394. I have seen, we're not going to get there even close I've seen teams in the low end get their labor cost per unit down under $1 by the end of the game. We're not even going to get close, okay? So think about that, what investments and whatnot you'd have had to make to get your labor costs under $1. But think also what that would do to your contribution margin, right? So huge, 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 okay? Erie might get theirs under $3 maybe. Yeah, what are they, 335? Yeah, they'll probably end up getting theirs under $3. It'd be my prediction on the labor side. A little money on the table, right? Andrews left some money on the table. Okay, and I think I'm going to make you go back and calculate one of those. It's been a few rounds, so you guys maybe you can go back and remember how to calculate leaving money on the table. This is in the traditional. I think the one I asked is in the low end, and I want to talk about that when I get to it. Chester actually took advantage of that a little bit, as did Erie a little bit, but that's, you know, that's pretty significant there. The 23% actual, it looks like they had about 28%, 29%, so they left about 6% of the market on the table. Remember, that market's getting bigger. Okay, so that's 1.3 or 13 million roughly, so 6% of that would be 780,000 units maybe that they could have sold at $25 a unit or so. 15 million in sales, something like that. And if we go to the low end, they did the same thing there again, right? So they left about 5% or so. Okay, your question is going to be about the low end. It's going to be, what did Andrews leave in the low end? And what I wanted to point out is this. Okay, they sold out of Acre in the low end. They did not sell out of Able. Okay, so what that means is that the potential when you're calculating it is going to be based on acres numbers, right? Okay, because I'm going to ask you, what they leave on the table in terms of sales profit and after-tax profit. Okay? And so what the one you'll look at is Acre, because they did sell out of Acre, and that's the one then where the potential, they could have sold quite a bit more, obviously, had they made some more, right? Could have sold about 6% of the market more. They could have sold another, you know, what I say, 700,000 units or something like that, whatever. You do the math, right? Don't take my math off the top of my head. Do the actual math. Erie took advantage of that a little bit, and so did each of these teams. Ferris left some money out on the table in the low end too, interestingly. Chester, Digby, Ferris, dominating the high end, pretty even in terms of potential and actual. Same thing in the performance. A little difference here. Chester took advantage. Digby gave up a little bit in the size. Again, here's where you get your numbers. When we talk about acre, right? Actual market 10.9. Potential would have been here. Wonder if we do have some more in the. No, Able actually sold more. Oh, that's interesting. Oops, acre. I'm sorry. Here's the one. Yeah. Able actually, I'm not going to make you do that. Don't do that. It looks like Able actually sold more than its potential. Okay, and so I could say you got to net that out, but don't net that out. Just tell me what acres, what they lost out on, right? Here it is. Their actual was 15.4. The potential here was 22.6. So, about 7% actually, 6.8%, right? We've gotten pretty well defined here. The low end's the kind of crazy one. You got a lot of them, but these guys are all fighting up here. Baldwin's picking up some scraps. It's basically what's happening there. The middle, the traditional segment here is just pretty well clustered. The low end's kind of spread out. That's not unusual in the low end, right? Because you got some products here that are drifting backwards. So HR, look at that Baldwin. One of the reasons they have such a high contribution margin, right? They're 49%. They're getting a 15% productivity boost in their employees. They have great employees. I thought this number was interesting. Chester had roughly the same sales as Ferris, right? But 200 more employees it's requiring for them. Probably automation would be my guess. And they weren't that far ahead of Digby in terms of sales, right? 30 million, that's substantial, but it's not that far ahead of Digby. But here again, 1,380 employees versus 733 employees. So they're not nearly as efficient, obviously, okay? And they've got more efficiency here. They're not quite as productive. So a little bit of it's here in the productivity of their employees, but then there's quite a bit of it that has to be up probably in automation and whatnot, I would guess, when we're comparing Digby to Chester in that case. Your wages. Labor contract next year, so yeah, Digby paid the highest. The rest of you guys had some strikes. That might have hurt you a little bit. Not all that long, although you really nailed. Apparently, you guys were far more generous than the computers, right? So the computers, both teams got nailed. They had 34-day strikes, so they were off for about a month. So that hurt them. Okay, that would hurt them in terms of their production, and those types of things would have been decreased. 12, 13, 18 days. Probably not a huge deal, okay, but it might have had a meaningful effect. But then going forward, I think this is the wages then that get paid going forward. So there's going to be a little bit of a disadvantage for Digby because their wage cost, salary cost is going to be a little bit higher, and Erie and Ferris is going to be the lowest, right? The rest of you guys are kind of in between there, but it's not a ton, okay? It's not a ton. More meaningful for Chester, though, and Ferris because they have so many employees, right? Baldwin could have afforded, right, to pay quite a bit. They don't have that many employees, although they're not making that much stuff either. But, Digby's fairly efficient, so is Erie. TQM, we still got some teams investing in TQM, good. 12 million, 9.5, 10 million. Even the computer teams are investing a little bit. Actually surpassed, Chester was the early investor, and these teams have surpassed, not by a bunch, but here reduction in administrative costs, although your administrative costs aren't all that high, a few $1 million. You know, so you're saving 30% of your admin costs. You're saving, I don't know, maybe maybe $1 million. It's possible, $1 million more in that area. Okay. Any questions about the round? I think that kind of hits it in a nutshell. It was interesting. It was a good round. We finally had a maybe. We'll go take a look. See if we had a change in leadership here. Earnings per share, Chester was still the top in earnings per share at 30. Right, we saw that. That's because of Digby's insistence of selling stock early on in the game. But ROE, Digby did have the highest. And again, I think that's as much, while Digby made more money, it's also a reflection on the fact that Chester has really allowed their company to grow in terms of equity, right? And largely because of no debt, I would say. Contribution margin, Baldwin wins that one. Stock price, Digby really shot up. Okay, really shot up. Also had the most profits, cash flow as well. So at this point, Digby had a 96, just crushed both the computer teams. That's awesome. If they didn't have any discounts, they're sitting pretty good, and no discounts. So there you go. And we had two teams that crushed both of the computer teams, so that's pretty good. Kind of in line with my predictions. Maybe by the end of the, ooh, look at that. Baldwin overtook Andrews because Andrews has both a leverage and a working capital deduction. So Baldwin's our third place team. Andrews still bringing up the hind end there. So a fairly close match. Okay, next week's assignment. I apologize, this one's not as long as I would have liked to have made it. I've asked so many good questions throughout the semester that it's getting more difficult to come up with good questions. So here we go. Oops. This one's not as specific as it needs to be. We talked about it. But on the cash flow, why did Digby have a positive number in the plant improvements category? Everybody know what I'm talking about there? Where we talked about that? Okay. Two, how much money did Andrews leave on the table in the low end? And I've asked you to calculate it in terms of sales profit and after-tax profits. And just as a reminder, it was acre. Was that the right? Okay, the right product. So, and then three, what are some of the hidden costs associated with excess capacity? I kind of I put it in quotation marks only because they're not hidden if you think about them. They're just hidden because they're not, easily identified on either the cash flow or the income statement, but they are nonetheless costs that you have when you have excess capacity. And in my opinion, excess capacity is anything less than producing at 200%, right? Okay. If you're producing at 200%, you're fully using your capacity because you're using both shifts. If you're anything less than that, in my opinion, you've got excess capacity. So every team, even Chester, which is using their capacity the best, even they still have some excess capacity. Okay, because they're not close to 200% yet on all their segments. They might be in some of them. So, okay, any questions about that? Questions about the assignment? Quick comment, there's only two folks that have even completed a round in the Comp XM, Jordan and Holly. How was it?
The questions were pretty tough.
Questions are tough, yeah.
Decisions are a little different too. It's a little different situation, but
The segments are different.
Yeah, the game's a little different. Obviously, they didn't want to do the same exact game, so they switched it up a little bit. The questions are really difficult. That's my questions. Maybe by comparison will seem easy when you get into that, right? How long did it take you to do one round and answer the questions? Yeah, about an hour, and you've got 5 rounds, so that's pretty consistent. And so I want to emphasize that we only got a couple weeks left now, 2 weeks of regular class and 1 week of finals, and so. And I know you guys have lots of other things that you have to do for lots of other classes. Some of them my class, right, and like entrepreneurship or whatnot. And so my admonition and my advice is don't put this off until the last minute. And it does count, I think 10% for your grade if I remember right. So don't put it off. You guys finished 1 round and you're able to quit, right? Now you can go back and start. Just pick up right where you left off, and away you go. So you can start and stop this thing, and it would certainly be my advice if you've got an hour. Well, you probably need to take an hour, I would guess, just kind of getting accustomed to getting signed in, looking over the rules, and doing that kind of stuff before you even start. Okay. Now, is your 5th round going to take as long as your 1st round? Probably not. You probably will get a little bit of a break as you go along, would be my guess. But I think it'd be really important to get going on it. Right, do it now while you do it now before you get crunch time in all your other classes. So, okay, all right.
We have 2 rounds left of competition.
2 rounds left of competition, and then you have your rounds 7 and 8. Okay, I'll try to make the questions harder for the next couple of rounds so that it's more in line with what you have to do for the comp exam. How's that? All right, that's all I got.